My name is Michael Guyad, publisher of the Lead Lag Report. Joining me for the hour is special guest Jeffrey Hirsch. Jeff, it's been a minute since I last saw you, so I'm glad we can reconnect at least publicly in this forum. A lot of people are familiar with you and with the Stock Traders Almanac, but for those who aren't, talk about your background and how'd you get involved in markets. I think, as I recall, you had some family history as well there, and what you're doing now.
We actually just celebrated the old guy's life. We had a little family and friends get together. My pop passed away last November at the ripe old age of 98. Nah, thank you. It was a hell of a run, but it was all really his doing. And he started in the business back in 1961 at a place called Indicator Digest, which was run by his cousin, my godfather, Sam Coslow, who was a songwriter. It wrote Cocktails for Two, My Old Flame, was a producer in Hollywood, did Copacabana with Carmen Miranda and Groucho Marx, and had an Oscar for a short. And Dad was in the music business, writing songs, had gone to Brooklyn College for the music degree and the GI Bill. And Sam had gotten burned in the market by selling his music publishing company to RCA, and the stock plummeted. And he got really interested in the market and ended up culminating in him running an ad for this newsletter that he started, Indicator Digest, out of Palisades Park, New Jersey. He ran an ad in Barron's back in 61, one of those A-B splits, two different headlines, and it hit. And he called up my father and said, "Yeah, I want you to run operations for me." And then about 4 or 5 years later, he had the epiphany to take all these indicators, patterns, cycles, trends, and put them together in a calendar format in the Stock Traders Almanac so that he could follow the market schedule along with his own. And he incorporated my mom was pregnant with me back in 66 and came out with the first edition in the fall of 67, 1968 edition. And it's been humbly a hit on Wall Street for 50, going on 56 years, which is how old I am.
It's been a go-to for me for a number of years. I always get, obviously, every single new iteration of it. It's interesting. You mentioned your father passing. The song I actually was playing at the start was a song I wrote following my father's passing in 2008. And I got it published and produced recently, relatively recently.
Wow.
And so you and I have the commonality of having family history and having our fathers have a big impact on our lives, on our careers. And I often wrestle with this question of legacy for myself. And I'm sure as you reflect on his life and how it impacted yours, what your legacy should be relative to his. I'm curious, Jeff, and I don't want to get too deep here or too personal, but when you look back at everything you experienced and how you look at markets, what is the most lasting impact your father had on the way you think about the world? And what have you thought about different things to maybe add to that?
He had a way of looking at things that I got that was a little bit outside of the box. People look at cycles very in a specific periods. He looked for events and things that cause change, systemic change in the markets and human behavior. And it was sort of like a natural innate ability of his that I think I picked up on a little bit. I don't want to claim that I picked up all of it, but I remember having discussions with other people at the office, some of the more seasoned writers, and they weren't getting the point he was making about one of these patterns, whether it be the monthly flows, cash flows, or whatever it might be. And I just sort of smiled, I get what he's saying. And it was that way of thinking and doing things by hand. I mean, I learned how to track the market using graph paper and a pencil and an adding machine back in the 80s when I was starting to run numbers for him, not like a bookie, but run the calculations for the Almanac, and just getting in there, doing things by hand and looking at things. You don't want to just run programs and have information spit out.
Yeah, the whole bit about doing things by hand. I had Tom McClellan on one of these spaces not too long ago, and we were talking about doing things by hand. And I do believe that people underestimate how much you learn by actually doing it, as opposed to having an algorithm or a computer spit out the outcome, right? Because it causes you to forcefully think and actually look at the day by day, week to week, month to month, quarter by quarter, as opposed to just let's put all this stuff into some kind of a computer, a calculator, and here's the output. Talk about how that transition from doing things manually to doing things more from a computer basis, how that may have impacted knowledge when it comes to investing.
It's careful what you wish for kind of thing, or be careful with a fancy tool. I mean, it's made doing the Almanac so much easier and less time consuming, and opened us up to anything. Like, we'll get requests from people. Now we can write a couple of lines of code and spit out some sort of table or chart that represents the query or hypothesis. So it's really a blessing. Remember that old commercial about this is your brain and this is your brain on drugs? This is Yale's brain, just totally blown up where we can do things very quickly. It's been a boon for us and it enables us to do a lot more. But, we still do some of it by hand. We still look through the data, like I'll plug in different years to get correlations and stuff. And when we pick our stocks, we run our stock screens. I don't just click the screen and it goes. We sort by the different criteria that we're looking at when we go through the fundamental aspect of the screen as well. So it's just, you got to be careful with the computers. It's like taking a little screen time break. You got to take a little macro break and run things by hand. And, you use the tool, but don't let it run everything in the background without you seeing what's going on.
What's the oldest data point that you have in Stock Traders Almanac? What's the thing that your father had gone back in time and uncovered?
Remember the Cows Commission?
I'm a little bit younger than you, so maybe not.
It's one of the books I still keep from him. It goes back. That's if you look back in the back of the almanac where they look at the 4-year cycle, it goes back to 1833. So that is data that was compounded by the Cows Commission, which is a famous work. So that's about the oldest data point, but that was just sort of like a yearly change. In our verified data, which I verified by hand across a few different databases, 1901 is the oldest real data point we have in our computer database. But to me, it's not necessarily the oldest that matters. And if you're looking at booms and busts, yeah, you go back to the tulip boom. But for the most part, we're looking at comparing different time frames since World War II, since NASDAQ started in 71, the last 31 years, last 21 years. We try to see trends that are consistent over multiple time frames. The shortest time frame I'll look at for a cycle is 21 years. It covers usually a full cycle, and 21 because if you have 20, you can get an even number. You can get a 50-50 on something,
Fair enough. Okay, now I'm curious also on this point that whenever you do any kind of analytical work using data that's older, there's a question of how accurate that data is, right? Because record keeping was not as advanced as it is today. Obviously, you didn't have computers, right? So and this is more just my own curiosity, are there considerations for sort of error rates based on the time with which data is calculated off of? How do you factor in the error risk there?
I think there's almost more error risk now with the high frequency and the intraday stuff. You look at different data feeds that don't have the accurate number. It's not necessarily any better. There's just so much more. We've uncovered some data errors. There was another book, the Pierce book, which had all the Dow numbers in it. And there was a changeover from, it might have been back in, I think it might have been 1914 close or whatever it was when the market closed, beginning of World War I. There was a printing misalignment on the page, and that error got picked up when I think somebody must have scanned it in or something, and it was a wrong number for a certain important date back in history. So just recently, people were talking about it being the worst start since 1923. It was the worst string of losing weeks since 1923. But they didn't catch the 1932 streak because they forgot about Saturday trading, which there was a Saturday morning trade. So the week didn't end on Friday, and somebody just lopped off all the Saturday closes from that history. And that's one of the things we track. I mean, it's a little bit of minutia and trivia, but facts matter, and I think that's one of the things that we pride ourselves on.
And I think it's important to emphasize because, as you know, right, you can have these data pieces of data that might be missed because that, as an example, is not even considered, but that one missed piece of data can have all kinds of implications because markets, can have these outliers and can throw the conclusions ultimately off if the magnitude is large enough. Now, you were jokingly saying the commercial, this is your brain on drugs. The drug nowadays is is momentum and all this gamification and all these emojis and all this kind of silliness around how to think about putting capital at risk just because of the availability of charts.
Yeah.
Taking the other side of that point about error, exactly to your what you alluded to, the noise is at all-time highs now, and the errors in the data, even though the data may be accurate in terms of being real time, there's a lot less signal because of all of the momentum drugs that charts feed down our throats here. Talk about how the availability of information has impacted some of the conclusions of what's out there in the Stock Traders Almanac, because I got to assume more people are trading off of noise and randomness than ever before in history.
I think it doesn't necessarily impact the Almanac stuff as much because we're looking at less noisy things. This is not a day trading tool, except for certain parts of it in the back where we look at intraday trading patterns. But I think some of that noise ends up getting smoothed out. Even the algorithms and all the computer programs are written by human beings, and there's bias built in there. And it looks for things that creates these patterns. And yeah, patterns are shifting and changing. We've seen for example, the monthly pattern starting back in the 90s when the payroll deduction started going mid-month into the stock market and needed a place to go. We saw that, the best days of the month, there's that spike mid-month around the 9th, 10th, and 11th days and 12th days that didn't used to be there. It used to be the last day of the month and the first four of the new month that were where most of the month the market's gains are made. And you threw in the middle section. So the noise, it's definitely something that needs to be filtered out. If you're in there trading intraday and you've got a system, that's great. But for people who aren't doing that and to watch the market throughout the day and all that noise, it really pays to pull back and use the things in the Almanac and use some of the more seasoned patterns and longer term patterns that are still valid. I mean, I've got this comparison of 22 versus 1962, 1970, and 1974 that I've been sharing out there in the Twitter spaces or, in Twitter, in my blog and the newsletter. And it's just amazingly similar, the shape of the performance. And those are all midterm years, which is another cycle that you got to bring in there. It doesn't work all the time. I mean, they're in the late 90s, the 4-year cycle was off kilter. Every year was up. There was no dip. But this is very typical midterm election year behavior. We've got a war. We've got an incumbent president and his party up against being knocked out of the Congress or losing control of Congress, which is very typical. And, we're in that weak spot of the 4-year cycle, which is also the worst 6 months. Like Q2 and Q3 tends to be very weak. So you got to tune out that noise and zoom out a little bit and have a look at some of the longer term patterns. It doesn't have to be monthly patterns, but at least, take a more distant view of things and not get so sucked into what's going on in the market every day.
Okay, now it's an interesting conversation because I want to push a little bit on this about cycles. And I often say that there are no gurus, only cycles, right? There are no gurus, only cycles, and people fall for the soothsayer on the hill when it's more just because of a moment in time that favors whatever factor or strategy, whatever it is. That's
but if you're a cycles guru.
That's what you are, my friend. So in that sense, you're the man for that. But
there's others.
Yeah, no, that's fair. But I will say that I do wonder if the short-term noise does impact the length of these longer-term cycles going forward, because to the extent that people trade off of noise and immediately respond to liquidity and the leverage delta, right, the kind of speed of leverage increasing or decreasing itself accelerates. If that means that cycles become shorter in time, that bear markets and bull markets just have different time aspects. How do you think about that aspect of it?
It does. It most definitely does. There's a lot more anticipating. We've seen shifts. We've seen cycles compress and shorten. I mean, up until 09, 08, other than 09, 08, there's bear markets have been shorter and shallower, since, again, World War II, 1950, or even since the 70s. It's just there's a compression of time on things. However, you still have these longer term cycles that still permeate, like what we're seeing here with this market. I mean, we've had a pretty lengthy decline, and it looks like it's continuing to go further. We haven't broken below the lows yet, but it's not that short anymore. This current correction, downturn, bear market, whatever you want to call it. So it's a little bit of both. I mean, you get some things compress and go faster, but if there's a more powerful force like this inflation and this war and the supply chain constraints and COVID, that's going to bring into play some of the longer cycles. And that's what I think we're experiencing here. And that's why we're getting this very typical midterm correction.
Okay, now the human mind always wants to find a comparison in history for what's happening in the here and now. And I think we can all agree that this is a very odd cycle in a lot of respects because of how high inflation is and in the sense of the way certain asset classes are maybe behaving to each other. But you're much closer to this than I am in terms of the underlying cycle data. Talk through here what periods in history are similar to this and maybe what periods in history aren't that people think explains what's to come.
We just updated this chart on Twitter the other day. I don't know if I can post it up in this thing or if you can. I think it's 2 days ago, and you can show the charts that I'm talking about. It was
the low retest in June, or
it was the one that's got the 6270.
Yep, I got it. Yeah, I'll share it in a second.
Yeah, that's what we're looking at. That's the comparison. And it's not just because of the shape of the market turn there, and it's not just because they're all midterm years. It's because of some of the geopolitical, inflationary, and Fed-related situations that were going on in 62 and 70 and 74. I remember 70 personally because I was 4 years old, but the market bottomed on my 4th birthday, which was just May 26th. So that sticks out in my mind, just luckily, for the comparison. I remember that. There's also when we had the Jackson State and Kent State riots and the death of some of the kids. So there was gun violence going on. There was war. There was protests. There was an oil embargo. There was in 74. There's like several, related events and what was going on with inflation and the Fed. Yes, this particular year is especially high and quick rise in inflation. But those 3 years really stand out to us. And initially we had 1960 in there when we first looked at it. But that was an election year and it wasn't quite the same environment in the world or similar environment. And those are the comparisons that we're looking at. I mean, it'd be nice if we didn't end up in a 1974 situation, but, in 1970, the market was down about 36% from the late 68 high, depending on which index you look at. 62 would be a little more palatable with a little June low here and then a sideways action and a retest in October, set us up for the sweet spot. But there's some things going on out there in the world, let alone the marketplace themselves, that is out of our control and is probably going to have some impacts on there. And this uptick in inflation today is another one of those surprises that has stocks reeling.
So part of any analysis when looking at historical data is presumably trying to identify where is there a structural change in cause and effect, right? That may make more recent data need to be more heavily weighted relative to older data. And what I have to assume, and maybe I'm wrong here, that getting off the gold standard and kind of the pre-1971 to post-1971 was a real structural break in the way these cycles have behaved. So I want you to talk about how things maybe changed in the data set and what changed when you come to the kind of pre-gold standard to post-gold standard period.
There's another moment that I think is important, and that's the 87 crash, which had a lot of systemic and structural changes in the stock market with the collars and circuit breakers that were put in. And that's one of the time frames we look at as well. I mean, the gold standard turned everything into, the U.S. currency into a fiat currency. It changed the way values and the market was behaving. And there was a lot of other things going on in the 70s there, other than the gold standard, with the oil embargo and then the technology. And this is when, right around the time when we had that discovery of the super boom that Yale made, where, war and inflation create these cycles. But there was this enabling technology called the microprocessor that really changed the world, which may have even had more of an impact on how the cycles changed than going off the gold standard, the two of them together. So a lot of things changed in the 70s.
And then the question, I guess, becomes, this is also kind of an interesting thought experiment, but how much of a sample size do you need to have confidence that the future will look like the past, right? I always go back to what's your N, right? What's your sample size whenever you do any kind of analysis based on history? So talk about how that maybe goes through some of your thinking, independent of what shows in the Stock Traders Almanac, because if we agree that things changed because of 87 or 1971, it's not clear that even up till now, there's enough data points to have any degree of confidence around averages.
I think that's plenty of data points. I'll use last. I mean, as I said, 21 years is the cycle I'll look at, but it depends upon what's available to you. Like if you're looking at Democratic presidents in their first midterm year of their first term, there's not a whole lot of cases of that. But if that's the situation on the ground, you got to use what you have. If you're looking for midterm years that had this kind of early drop, there's only a certain amount that you have there. So the more data points you have, the more confidence you can have in the pattern. But some patterns have to be a little bit shorter. I mean, everyone's looking for the seasonality of cryptocurrency or Bitcoin right now. And you're getting up to maybe 10 years or so, maybe less, looking at the recent move in Bitcoin being different than the previous 5 years. But I don't think that's enough for a seasonal pattern for that asset. But, you have to be a little flexible. You look at lots of technical indicators and fundamental indicators as much as anyone, and it depends upon, the situation. If you're looking for something that's that goes back a little further, like a 4-year cycle, you're gonna have to go back a longer data point. You're looking at how June behaves seasonally. You might not need to go back more than 20 years to compare the seasonal intra-month fluctuations of the month of June or any other month. So yeah, 20 is about the number that you look at in general, though.
All right, so let's pivot a little bit to some of the things which people often reference, I think, when they look at Stock Traders Almanac, and you often hear that fantastic "sell and May go away" line. Everyone loves to say that line, and I always joke that the best time to have done "sell and May go away" was May of last year and stay away, given the way that things have kind of behaved here. But I want you to talk about some of these seasonal patterns in terms of the best 6 months, the worst 6 months. How should people think about it? And what does it actually mean? Because from the studies I've seen, sell in May isn't necessarily about stocks going down, but rather just suboptimal returns.
Exactly. That's a valid point. Do people know what the full old saw of sell in May and go away is? Do you know what it is?
Well, as I understand, it's primarily based on the farming cycle, which we can talk about, but I don't know beyond that.
Yeah, but it's an old British saw, and it's sell in May and go away and come on back on St. Leger's Day, which is the St. Leger Stakes horse race, which is the final leg of the British Triple Crown that occurs in September. So it's actually not based on farming anymore, because I have a chart that I show in my presentations on the 6 months, which we show the first half of the 20th century, 1901 to 1950, versus 1950 to 49, excuse me, then 1950 to the present, and my 87, or we use 88 to the present. And back in the first half of the last century, it was buy in May. That was the farming cycle when the economy was driven by the cash flows in and out of the agricultural industry. And you see the chart where the market rises from May to September, up from planting to harvest. The best 6 months really revolves around the sort of vacation summer cycle where you have these summer doldrums from Memorial Day to Labor Day, which runs very similar to the London season, which if you watch Downton Abbey, you might have or some of those shows, you get a taste of it from September through May. That's when all the business goes on down in the city. And then having been built on an old swamp or some lowland, hot, muggy area, everyone goes up to the country around May, and that's when you see that lull in business activity in the stock market. So back in 86, when Yale put together the 87 Almanac, he found that most of the market's gains were made from November through April, and then it pretty much went sideways from May to October. So everyone looking to sell in May, and it didn't work because it didn't go down. That's not how the system works. But we do a comparison showing that, the gains in the Dow, for example, about 7.5% since 1950 in the best months, November to April, about 0.8% in the worst months, May through October. There are some sectors that we like during those periods and some defensive strategies. But then we roll in everyone's favorite technical indicator, MACD, to time those entries and exits in and out of the best and worst months more effectively. And it's added quite a bit of alpha to the strategy. And it was actually something that, remember Cy Harding, the late Cy Harding, Ryan Bear? He took our best 6 months, worst 6 months switching strategy, and Jerry Appel's MACD, and combined them and called it the best mechanical system ever. And we've tweaked it a bit ourselves, and we look at the 817.9 on the buy side and 1226.9 on the sell side, and we also make sure that both the buy and sell are in agreement and that you get a confirmation across more than one index. And it's amazing how it continues to work. Not working great this year. Nothing's perfect. As I say, nothing works 100% of the time. I don't work 100% of the time. I will take some time off and play some golf, have some dinner with the family, go away somewhere. But, it's still a very powerful strategy, and adding MACD to it makes it even more effective. I love the combination. People argue about technical analysts, fundamental analysts. You got to use it all. I find you get some increased results by crossing fundamentals and technicals. And, in my book, seasonals fit in there very nicely as well.
Okay, but now let's talk about seasonals and in the construct of sell and May go away when it comes to bonds for a moment. Because the other side of this is, even though equities, as I understand, tend to be much weaker, even though on average still have positive returns during that sell May go away period, bonds, from everything I've seen, and I've done some research on this, especially when it comes to 10-year yields, they tend to drop.
The yields drop.
Right, on average, right, the yields drop. So talk about that dynamic a bit. Why is it that bonds have that seasonality, if there's any kind of causation in history?
I mean, we switch into bonds in the worst months because while the yields may drop, the bond prices are going up, and it's an inverse correlation between stocks and bonds. The causality is that people are getting out of their stocks, and where do you put your money? It's not quite a flight to safety. It's a seasonal flight to safety. It's something we've tracked the 10-year Treasury doing better on a price basis during those same worst months. You might be better off getting into utilities, which is a sector that does very well, especially with all of the electricity for air conditioning and driving and all the action that happens to the energy and generation business in the summer months here. We use a lot more energy in summer. Less gas, less straight gas for heat, but the air conditioning business generates quite a lot of electrical revenue for the utility companies.
But I'm glad you mentioned utilities because that's referenced in the 2014 Dow Award from the CMC Association and to market approach to beta rotations. But utilities are, of all the sectors of the stock market, from my own studies, are the only sector which tend to not have that seasonality behavior during sell may go away. To your point, they tend to do actually.
It's the opposite.
It's the opposite, right?
Yeah, in the Almanac sector seasonalities, I think it's March to October, if memory serves, is that seasonal period for bullish period for utilities. In March to October.
Right, and it makes sense, right? Because they're highly levered and they are sort of the bond market proxy. So if bonds are doing well during the worst 6 months, you'd expect the bond market proxy utilities to do the same. But I want to bring that a little bit to the here now, because one of the great frustrations for me is that you have this unbelievable disconnect between the behavior of utilities and the behavior of treasuries. So usually, right, to the earlier discussion, utilities will outperform when yields are dropping. Why? Because they have to roll over their debt. They're highly levered. Most of their earnings volatility is driven more by interest expense volatility. So have you seen anything, Jeff, on periods where there are these massive disconnects between utilities and the message of the bond market, like what we're seeing this year?
I think it has a lot to do with the energy prices and as much, if nowadays, if not more, than the bond correlation. And you're seeing the XLU and the XLE both doing quite well right now. And I think there's a newer correlation and a strong correlation with utilities and the price of energy. They're just making more money by handing that price over those of us that are consuming it. So I see a connection there with the energy market and the energy prices, and I think that's what we're seeing here in 2022.
Yeah, no, it's just it's I don't know what's going to cause that to converge so that the two kind of give the same message. Maybe it's just the energy itself breaking, which is plausible. Okay, so let's keep going on cycles because I think everyone is more and more convinced that we've entered a secular bull cycle for commodities. There's a lot of these, and I'm very much in that camp myself. When you look at some of these longer term relationships of equities to commodities, you're just starting to turn where commodities could meaningfully outperform equities from a multi-year perspective. But what does some of the cycle work that you've done suggest about commodities, about inflation, and about how consumers are probably going to respond to it?
I mean, we look at the seasonal aspects of the different commodities. We did the Commodity Traders Almanac, which we're considering resurrecting later this year.
Now would be good timing. On that, right.
And a lot of those seasonal cycles still work. I mean, we use them in our newsletter, especially the energy ones, the gas and oil and copper as well. It's a great seasonal trade from December to May by using even correlated stocks, like some of Freeport McMoran or something like that. But, we've been looking for this inflation for quite some time. It's part of that super boom forecast that, I made back in 2010, with the Dow around 10,000 for 38,820 based upon the pattern that Yale discovered back in 76. And we're finally getting that. And it's coming a little bit fast and furious, obviously. But, it's part of that whole super boom cycle. You're going to have commodities going higher. We've got more people on the planet. We've got some other supply and geopolitical risks out there. But it's something that's here, and it's going to keep moving. It feels like with the last bull cycle started, 99? Was that where you counted from?
Yes, it was based around the time that tech started breaking down with the tech wreck, right?
Yeah, so you can correlate the tech wreck of the dot-com bust to what we're experiencing here. And there's a correlation with growth, tech stocks taking a breather, and commodities and more value and dividend and yield generating types of investments taking the forefront there. And I don't think the equity market secular bull is over by any stretch of the imagination. This is a cyclical bear within the secular bull. I'm expecting a very typical rally from a midterm low to a pre-election year high, which we've talked about quite some time. And I think we'll be looking a year from now at new highs potentially you're taking back all of this downside. You get a changeover in Congress. You get the best combination for the market. Democratic president, Republican Congress. And you see this kind of rally of the Dow about 50% off the midterm low to the prediction year high. And NASDAQ averages about 68%. The secular bull is not over in the equities as far as I'm concerned. Even though when we had the last secular bull start for commodities, that was the end of that secular bull market there, the 2000 top there. So,
but presumably there's new leaders that would drive that, right? I mean, that sounds like a very non-consensus view, and I have no idea, like everybody else, if it's going to be right or wrong, except with hindsight. But if that's the case, a year from now, do you think it would be the same tech names that are driving it? Talk about some of the rotation aspects here.
I wonder how long this crypto bubble, digital asset bubble, could continue. That's helped fuel this. You would think that, there's a whole streaming battle out there that's falling apart. Facebook's down 50%. That leadership is gone for now, as far as I can tell. I wish maybe it's cybersecurity. Maybe there's something new out there that we don't know about it. I'm not a technological innovator here, but maybe it's Web3, maybe it's biotech. After the big drop, we had a big lead with biotech. Maybe there's something in the energy technology industry. Something new's got to come out there. We still have all of this communication stuff like we're using here on Twitter Spaces, whether it's Zoom or GoToMeeting. Maybe there's something in the communications area communications tech or fintech, one of our favorite areas that we're all using right now. So there's likely to be some rotation.
How do you look at, or if you, or I guess, do you look at market cap when it comes to cycle movement? So if you were to look at the Russell 2000 relative to large caps, right? So small divided by large. What's amazing is that despite all the academic research that shows that there's a small cap premium, the relationship of small caps to large caps is basically back to 2009 levels, which means that if you were in 2009 buying small caps or large caps, you pretty much were break even with a lot of volatility in between. How do you think about market cap and where investors can use the Stock Traders Almanac and some of the research you've done to help tilt the average market cap of their equity portion of their portfolio?
I think you got to be spread out in market caps. I mean, I used to do more with micro caps that didn't have reportable numbers. The only stocks we look at right now have to be kicking off revenue and earnings growth, and we look for acceleration there. Right now, our portfolios and newsletters are down to pretty much large caps. Things have been stopped out and down. It's probably getting to that point where you're referring to where small caps are ready to take over, but some of the overarching impacts that we've experienced with pandemic and war, inflation and supply chain stuff tends to hit the smaller cap stocks, and inflation tends to hit the small cap stocks a bit harder. And the large cap value is what seems to be strongest. I just did a webcast with the guy from Constellation Energy, Ed Fortunato over there, and we just did our stock update, and Constellation was spun off of Exxon, which is one of our picks that came through the screens a few years ago. And Constellation is the best performing stock in our large cap portfolio right now. So we go towards where the performance is. So it'd be nice to have more small caps in there, but it's not working right now. So you got to wait for that signal, that turn, for some performance to show up in whatever research that one does. In our stock screening research, it'll show up for us. We'll see which companies, which capitalizations, which industries are reporting revenue and earnings growth and have good valuations and are flying under Wall Street's radar. So we'll let the data tell us and guide us there.
Yeah, speaking about cycles, one thing that seems to be in a permanent secular bull cycle is leverage in the system. And I have to assume that leverage becomes maybe a complicating factor in terms of cycle work and sequence of returns within the cycle, because I always go back to this point, leverage is the necessary precursor to conditions that favor a crash in any asset class. And you end up having these tail events present themselves more often because the speed with which people, and the Fed in particular, releverages means that you constantly have this constant rolling risks.
Isn't it the actual deleveraging that becomes the problem?
Correct. Exactly right. And then of course the response is relever, and then it gets bigger, right? So you never fix the problem. But how does all that, if at all, factor into some of the conclusions in terms of how you think about the historical patterns and cycles that you put out there?
It's driven them. This leverage is unwinding, and we made mention of it. With this month is when quantitative tightening is beginning. I mean, it may be one of the reasons that we're getting this kind of sell-off here. It's not really being spoken about enough, and I think we saw that happen in 2000. Of course, 29 and 87. All these crash and periods that we know were triggered by an unwinding of leverage. And I think we're experiencing some of that right now. It does create these patterns and these long-term cycles of market drops and market rises. I mean, the relevering, it's been going on incessantly since 2000 and even more so since 08 and 09. And people have been worried about it and claiming it's not good for the market. And I think there's a bit of comeuppance right now that this is what we're dealing with. And it happens to be happening in a midterm year. I think these kinds of things exist. These kinds of cycles and patterns exist because people behave the same ways or similar ways with different regular events. There's no other government in the world that has a regular election every 4 years.
And that's 100% valid.
And I think that the leveraging, you will probably end up levering up a little bit as we get into that pre-election year where incumbent parties try to prime the pump to get reelected if they can help stimulate that with whatever fiscal policies or programs they put out there. But it's hard to relever after all the leverage and the multiple and the decade of zero interest rate policy. It's got to unwind.
So that goes back a little bit to the sample size point. And I am curious, because I assume this is the case, Jeff, but maybe I'm wrong, that there have been things that maybe have been observed in prior editions of Stocktrader's Almanac where suddenly maybe for whatever reason there's some causation, some flip in the correlation that makes it not worth kind of putting out there or emphasizing because it doesn't matter anymore. Are there any things that you've seen that are not anywhere near as effective or maybe not effective at all compared to history that people often think about when they look at seasonality?
Everyone expecting the market to sell off in May. I think the fact that folks are skeptical of seasonality helps it stay relevant and effective. And I think it's the skepticism that helps drive it because people continue to behave in the same manner year in, year out. Everyone's getting ready for summer vacations and August the doldrums will be there. It'll be quiet. The market will probably hit a low. We've seen some shift in October. There was this whole October phobia thing. It's actually become quite a bear killer month. Let's see. One of the changes I mentioned earlier was the mid-month spike. I think the first trading day of the month is an amazing pattern that continues. It's not every first trading day, but first trading days of the month are amazing that they continue to outperform.
And that has to do with sort of the structural money that comes in from paychecks to then get allocated to equities.
It has to do with that and the fact that managers are doing monthly reports. Do your report. Your performance is posted up there monthly, almost like gasoline prices at the gas station. It's not just the money coming in from payrolls. It's also that people are geared towards monthly performance. And same with quarterly performance and annual performance. That's what creates the best months is that people are getting geared up. And you've got that October 31st deadline for transactions for mutual funds, which creates that October volatility and October phobia.
One of the wildest patterns, which got a lot of attention a couple of years ago, but I haven't heard too much of it recently, is this observation that if you simply took out or looked at the day before the Fed meeting, the day of the Fed meeting, the day after the Fed meeting, that almost accounts for almost all of buy and hold returns, which is utterly insane. But talk through that a bit because that's a really curious one.
Pre-Fed announcement drift.
Exactly.
Yeah, we looked at that. There's no there. It's anecdotal or you could work. It's just not. There's nothing that you could really pinpoint empirical data-wise that it actually worked.
Oh, is that right? Because I've seen some. Maybe I'm off on that, but I remember seeing some white paper that argued that was such a. Maybe I'm getting the anomaly wrong, but that was the sort of key area to generate returns in. It's just around Fed actions.
I think the white paper was done without recent data. I'm not sure exactly. I don't know the white paper, but I know the results. And we looked at it with the portfolio that we were running, and it did not add any benefit to the strategy.
Interesting. Okay.
So I think one of the reasons that it's faded from the media and from people talking about it is because it stopped working.
Okay. So this is, I'm glad you said, because this is kind of an interesting pushback that I'm sure you've heard. I've heard it as well as it relates to my own signals and my own research. This idea that once you uncover some kind of pattern, it gets arbitraged away. People start passing off of it, and the anomaly goes away.
Perfect example, the trade in the Thanksgiving markets. We have it in there. When Yale published that in the 87 Almanac, it was like 43 out of 45 years, the Friday and Monday worked. And then it stopped because we published it and everyone started arbitraging it and jumping on it and anticipating it. There was a quote that I'm putting in the Almanac this year that is, I think it was Lucian Hooper, the old Wall Street reporter. He said, once you find the key to the markets, they change the locks.
Now, but that's kind of interesting, though, because I've often argued that you need to have those periods where it's not working for it to work again. You need to have this kind of successive periods of false signals for people to give up on the anomaly that's being arbitraged away, which makes the anomaly come back because there's less dollars actually trying to arbitrage it.
So best 6 months, worst 6 months, perfect example of that.
Right, exactly. And I think that's an interesting thing about the pushback that once data is published, it's pointless because everyone will start acting on it. That may be the case initially, but then to your point, it gets faded from people's memories because they underperform. They have these periods where it's not working and they give up. I always make this point that false signals create doubt, and doubt is the necessary condition for an anomaly to return. Is there anything in maybe prior almanacs where it was published, it seemingly stopped working for a number of years, but maybe it's kind of interesting to bring back as maybe could be kind of reasserting itself?
Nothing's reasserting itself right now. The January barometer has not been great the past 20 years or so. Most of those errors there. We've made some changes where we're adding in the Santa Claus rally in the first 5 days for the January indicator trifecta. Some things that are coming back. I mean, I've seen things relegated to the graveyard that haven't come back. I think things are changing. I mean, the best 6 months has a couple of bad years, 07, 08, 08, 09, and then it comes rallying back. So that's, again, I keep going back to that one seasonal pattern that's still consistent. That may be the one that's shown its capacity to restake its prowess after not working a couple of times.
Yeah, no, I just think it's interesting to kind of think through that dynamic because it's, even like I alluded to before, I thought there was supposed to be the small cap premium and there hasn't been one. So maybe it's about time that it comes back, right? I think people forget that there are cycles in anomalies also.
And one of the things that we look at when these seasonal patterns aren't working, ones that are persistent and consistent, it's a negative indication. Like when the best 6 months didn't work this year, that's a bearish signal right there. When the market doesn't go up from November through April, you've got a market that's got some real problems, that there are a lot of forces at play. And when that seasonal period ends, those forces are going to take over. And I think we're experiencing some of that this month and right now.
Yeah, no, I think, and that's the other thing too, right? It's like, I don't know if we've ever had a cycle quite like this in terms of the sequence of returns. And how do you navigate an environment where seemingly everything's acting the same way? I keep making this point that treasuries are acting like equities. Even like today, S&P is down 2.7%, long duration treasuries down over 1%. Still outperforming, but it's not
cash. Michael, you got to just sit with the bat on your shoulder sometimes. We've got a lot of cash in our portfolios right now, and we're just waiting. Cash is a position, and you don't have to be in something. Everyone wants a stock of the month pick. And okay, maybe you just want to put your payroll deduction or your monthly investment in your cash account or your IRA or whatever, and just wait. And wait for a fatter pitch to allocate that into equities or bonds or whatever your diversification model is. Sometimes you just got to wait. And I know it's hard. Everyone's impatient these days. They don't want to wait. Kids aren't taking camp jobs these days because they're not allowed to use their phone. They have no patience to just sit there.
Isn't that what's interesting to me? It's like, on the one hand, that's wildly frustrating. But on the other hand, that's also where you can really make a lot more money than everybody else because it's so obvious and easy to see the insanity that's unfolding in front of us as long as you just have some historical context. But it's also maddening because you see all these kids making money in Dogecoin or in other cryptocurrencies, these kind of joke coins. And you may know that deep down it's not going to last, but it's also really hard because everybody gets sucked into the desire to run with the crowd.
Yeah, there's that whole madness of crowds thing, right?
Unequivocally. and it does become hard to be sane in these kind of periods too.
Yeah, you got to try to be sane. And again, just patience. And this is typical for this time of year and this time in the 4-year cycle. And I think you just got to be a little patient. And there's a couple of things that I think, like when everyone's saying, should I buy? That's not the bottom. When you start hearing, should I sell? Should I sell? That's the bottom. When something blows up, like Lehman or an Enron or long-term capital or some crypto guy or hedge fund guy, when something really is done, that's probably the bottom.
No, and it's interesting because from that perspective, you can argue it's a lot easier to tell where the bottom is than the top, right? Because you have that liquidation, you have that catalyst, and you have this, I've used this point before, you have this feeling of almost PTSD. You have to get to a point where the emotion is so vitriolic to ever invest again. And it's very visible, right? Because you can see it in the way people talk about it and the way people are allocating. That's more observable than a top.
One of the reasons we use two different time frames for MACD buy and sell is because tops are more of a process and bottoms are more of an event. So we use the slower, longer period MACD for sell signals and the shorter, faster MACD for buy signals because it happens a bit quicker.
Yeah, no, that makes a ton of sense. So I'm curious, Jeff, maybe just a little self-promotion for you, but it's the middle of the year. Should people be buying Stock Traders Almanac now, given there's 6 months left, or should they wait for the next update?
How about they come take out a subscription at
StockTradersAlmanac.com,
and we give them the book for free, and they'll be signed up to get the next book when it comes out. And you'll get some more timely market analysis, some ETF sector rotation ideas, as well as individual stocks and general outlook for each month in the future. And, you could go take out a free trial. If you click on one of the things, there's a 7-day free trial, so you can read what we've done recently, kick all the tires, and it's not super expensive. And if you don't make it the price of the subscription in one trade, you shouldn't be doing either.
And by the way, I will say for everybody, I'm a big fan of Jeff's, and also because he's basically doing what everybody should be doing, which is he's backtesting and looking at things historically instead of just saying things haphazardly. Right? I always go back to this point that there's so much bullshit with what you hear with financial media, because most of the times, whatever people talk about as being predictors, when you actually backtest it, there's nothing there. So you've got to, at the end of the day, look at history, and then you'll have people saying, I don't believe in backtest, but they believe in buy and hold, which is a backtest on trade. So having that data-driven approach is something I wish more investors would consider. And following your work, Jeff, I think you do a lot of good to the community for those that are willing to actually think as opposed to react. So with that said, you joined us here, and everybody enjoy the rest of your day.